I need to address something that is confusing every single person in the precious metal space right now. Gold is crashing. Silver is crashing. During a war, during the most devastating energy crisis since 1973, during a period when every textbook says gold should be going up, and it is going down. Gold is below $45,000, below 68. And I know that if you own precious metals, you're looking at this and thinking something is broken. The safe haven trade is broken. Gold does not work anymore. Silver is dead. It is not broken. And I am going to prove it to you in this video. Because what is happening right now is not a failure of gold and silver as assets. It is the result of a chain reaction that started with $170 oil and ended with the most violent margin called death spiral in the history of commodity markets. And once you understand the chain, the crash stops being confusing and starts making perfect sense. Terrifying sense, but sense. I have 7 pieces of this puzzle to show you. Oil at 170, the Fed trapped. The margin call spiral, the CME raising margins at the worst possible time. Congress introducing emergency vault legislation. Because the system is choking, and China quietly hoarding every ounce of silver it can get its hands on before an April 1st deadline. 7 pieces, 1 picture. Stay until the end because the last piece, the China piece, is the one that tells you where this is going. Welcome to the Hidden Economy. Hit subscribe and hit the hype button right now. Drop a comment and tell me, did the crash shake you out or are you still holding? I want to know. Let's go. Let me start with the trigger, because everything flows from one event. Dubai crude oil just hit $170 per barrel, 170. That is not Brent crude, which most people watch. That is Dubai crude, which is the benchmark for physical oil in the Middle East. The actual oil, not the paper, the physical barrels that Asian countries need to keep their economies running. And those physical barrels just hit 170. To put that in perspective, Dubai crude was at $65 before the war started on February 28th. In 3 weeks, it has gone from 65 to 170. That is a 160% increase in the price of energy in 21 days. There is no historical parallel for this. The 1973 oil embargo doubled oil prices over 6 months. The 1979 revolution doubled prices over 12 months. This crisis has nearly tripled prices in 3 weeks. The speed is unprecedented, and the speed is what broke everything. I want to make this real for you because 170 sounds like just a number. Here's what $170 oil means in your daily life. Gas at the pump is heading toward $8 to $10 per gallon. Airlines are already canceling routes because jet fuel costs are unsustainable. Trucking companies are adding fuel surcharges that will hit every product you buy. Your grocery bill, which already went up 49% on vegetables, from the PPI data, is about to go up again because every single item in the grocery store was delivered by a truck that runs on diesel. Heating oil for homes in the Northeast is going to be devastating. And every manufacturer who uses petroleum-based inputs, which is basically every manufacturer, is either raising prices or shutting down production lines. This is not an oil spike. This is an oil shock. And oil shocks do not reverse quickly, even when wars end, because the infrastructure damage takes months or years to repair. Qatar's LNG facility has structural damage. Saudi Arabia's only alternative export route just got hit. Kuwait's refineries are on fire. This damage does not repair itself when a ceasefire is signed. It repairs over quarters and years, and that means the inflation from this oil shock is going to persist long after the headlines move on. When oil goes from 65 to 170 in 3 weeks, it does not just affect gas prices. It creates a shockwave through every market on Earth, because oil is the input cost for 45,000 products. And when the input cost nearly triples in 3 weeks, the entire global economy has to re-prick simultaneously. Supply chains crack, transportation costs explode, manufacturing margins evaporate, and the inflation that was already running hot from the PPI data goes from hot to uncontrollable. And that is exactly what the Fed saw when they met this week. The Federal Open Market Committee held rates at 3.5 to 3.75%. No cut, no hike. They are frozen. But here's the part that crushed the market, the dot plot. The Fed's projection of future rate cuts went from 3 cuts in 2026 to 1. 3 to 1 in a single meeting. The market was pricing in 3 rate cuts to help the economy through the war. And the Fed just said, you're getting one maybe, and it might not come until December. Higher for longer. That phrase is back. And it killed precious metals because when the Fed says higher for longer, it means the dollar stays strong. It means yields stay elevated. U.S. 10-year Treasury yield crossed 4.27%, 27% this week. When you can earn 4.27% risk-free in a U.S. government bond, the opportunity cost of holding gold, which pays 0 yield, becomes enormous. Institutional money flows out of gold and into treasuries, not because treasuries are exciting, but because they pay a yield and gold does not. That is the math, and the math does not care about your feelings about safe havens. Here's the irony I cannot get out of my head. The Fed is keeping rates high because of inflation. Inflation is caused by war and $170 oil. Gold exists specifically to protect against inflation. So the very inflation causing the gold crash makes gold necessary. The market is selling the solution because of the problem. That is the paradox at the heart of this crash. Paradoxes resolve. They always resolve because eventually someone asks, why am I selling my inflation hedge? During the worst inflation shock in 50 years? And then the buying starts. But the Fed is not the reason gold crashed this hard, this fast. The Fed announcement was the nail. The coffin was built by something much more violent, the margin call death spiral. Here is what happened in the order it happened. Oil spiked to 170. Every hedge fund and institution that was short oil or short energy got obliterated. Their positions went massively negative overnight. Margin calls hit. They needed cash immediately. Not tomorrow, not next week. Now, this second, post the margin or get liquidated. Where do you get cash when you're hemorrhaging money on energy positions and the stock market is crashing? You sell your winners. You sell the assets that are liquid and profitable. And what has been the most liquid and profitable asset class of 2026? Gold and silver. Precious metals have been the best performing asset class of the year. Every institution owns them. And when margin calls hit, institutions sell what they own. They sell gold at $4,500 because they need cash to cover the oil loss that is costing them 10 times more. That is why gold crashed during a war, not because gold is broken, because institutions needed cash, more than they needed gold. And gold is the most liquid asset on Earth. It trades 24 hours a day in every currency, in every time zone. When you need 200 million in 30 minutes, you sell gold. Nothing else gives that liquidity. And then the CME delivered the final blow. They raised margin requirements. Gold margins went from 6% to 8%. Silver margins went from 11% to 15%. In the middle of the crash, scrambling for cash, the exchange said, you need to post even more. That triggered a second wave of forced liquidation. Traders who survived the first margin call got hit by the margin hike and had to sell more, and the selling fed on itself. Price drops, more margin calls. More selling, more price drops. That is a death spiral. And it is exactly what happened to gold and silver this week. And the retail wipeout was catastrophic. Leveraged ETFs like SLV saw trading volume that exceeded Apple and Amazon combined. Billions of dollars of forced liquidation from retail traders who were holding leveraged silver positions, without enough margin to survive a 15% requirement. These are not hedge fund managers with deep pockets. These are regular people who put their savings into silver because they believed in the thesis. And the CME's margin hike wiped them out. Not because the thesis is wrong, because the margin math changed in the middle of the war. That is the cruelest part of this crash. The people who were right about the fundamentals got punished by the mechanics. I've seen margin call cascades before, but nothing like this. The combination of 170 oil, a hawkish Fed, and a margin hike, all hitting within 48 hours, created a perfect storm of forced selling. That overwhelmed every buyer in the market. The crash was not rational, it was mechanical. Algorithms and margin systems do not think about whether gold is a safe haven during a war. They calculate margin levels and execute liquidations. And when every margin system is liquidating simultaneously, the price does not find support. It just falls until the selling is done. Now, let me tell you about something that happened on March 19th that is the most underreported story of this entire crisis. The United States Congress introduced the Silver Act, the System Integrity through Licensed Vault Expansion and Resilience Act. 2 congressmen filed this legislation. On the same day, the market was in free fall. And I need you to understand what this means, because it tells you something that the government knows, but is not said publicly. The Silver Act addresses the fact that nearly all approved precious metals depositories for the COMEX futures market are concentrated within a 150-mile radius of New York City, all of them in one small area. And during this crisis, with extreme volatility and record delivery demands, the system for converting paper contracts into physical metal has been choking. The infrastructure cannot handle it. The pipes are too narrow. The vaults are too concentrated. And Congress just admitted it by introducing emergency legislation to de-risk the system. Let me explain why vault concentration matters, because most people have never thought about this. When you buy a silver futures contract on the COMEX and you stand for delivery, the physical metal has to come from an approved vault. Those vaults are all in the New York area. If you are a manufacturer in Texas who needs silver for solar panels, the metal has to be shipped from New York. If you are a mint in Utah that needs silver for coins, the metal comes from New York. If you are a tech company in California that needs silver for electronics, New York, everything funnels through one geographic area. And when extreme volatility hits and thousands of contracts simultaneously demand delivery, that funnel becomes a bottleneck. The metal cannot physically move fast enough. The trucks cannot load fast enough. The paperwork cannot process fast enough. The The system chokes. And that choking is exactly what has been happening. The exchange halts, we have seen the CME in November, the CME in February, the LME last week, are symptoms of a system that cannot handle the physical demand being placed on it. The Silver Act is Congress saying, we see the problem, and it is a national security risk, not just a market risk, a national security risk because silver is a strategic material used in military applications, electronics, solar energy, and medical devices. And having the entire delivery infrastructure for that strategic material concentrated in one area during a war is a vulnerability that the government can no longer ignore. When Congress introduces vault expansion legislation during a market crisis, it tells you the system is closer to breaking than anyone in authority is willing to say on camera. They do not file emergency bills for fun. They file them because someone at the CFTC or the Fed or the Treasury told them privately that the precious metals delivery infrastructure is a systemic risk and they need to fix it before it fails. Think about what that means for the paper price of silver at $68. The paper price says silver is worth $68. But the US government is so concerned about the delivery infrastructure that they are rushing legislation through Congress to expand vault capacity because the current system cannot handle the demand for physical metal. If there was no shortage, if paper and physical were aligned, if the system was functioning normally, this bill would not exist. The Silver Act is the government's admission that the physical market and the paper market have diverged so far that the infrastructure connecting them is at risk of failure. And now, let me tell you about China because this is the piece that changes everything. China is pulling refined silver from global markets completely. This is not a reduction in exports. This is a withdrawal. Chinese tech companies and solar manufacturers are aggressively hoarding physical silver ahead of an April 1st deadline when domestic export tax rebates expire. After April 1st, it becomes significantly more expensive for Chinese companies to export silver. So before that deadline, they are buying every ounce they can find and keeping it inside China. Let me explain why April 1st is so important. China currently gives its exporters a tax rebate when they sell refined silver overseas. That rebate makes it economically viable to export silver to London and New York at competitive prices. When the rebate expires on April 1st, Chinese exporters will have to pay the full tax on exports, which makes their silver more expensive on the global market. The result is that Chinese silver stays in China. It does not flow to London. It does not flow to New York. It does not flow to the COMEX. And the vaults that have already been draining for months lose their biggest potential source of resupply. And here is the timing that I find devastating. The COMEX vaults are already down to 335 million ounces and falling. London froze in October. The SHFB has 9 million ounces. The 12% lease rate tells you borrowing is at desperation levels. And now the world's largest source of refined silver is about to cut itself off from the global market in 12 days. 12 days. April 1st is 12 days away. And after that date, the global silver supply chain permanently changes. Let me tell you what this means in practical terms. China is the world's largest refiner of silver. When China stops exporting refined silver, the global market loses its biggest source of supply. London cannot refill its vaults. New York cannot refill its vaults. Now, the 12% lease rate that I have been talking about for weeks is going to look cheap compared to what comes when China's supply is completely cut off after April 1st. And here's the disconnect that I keep coming back to. In the West, margin calls are forcing the paper price of silver to $68. Institutions are dumping silver futures to raise cash. The paper market says silver is worth less. Meanwhile, in the East, China is hoarding every physical ounce it can find before a deadline that will cut off global supply. The physical market says silver has never been more valuable. Paper price crashing, physical hoarding accelerating. Two markets, two realities, same metal. This disconnect is wider right now than at any point in this entire bull market. Wider than when London froze in October. Wider than when the CME halted in November. Wider than when Shanghai was at a 13% premium. The gap between paper and physical silver has never been this large. I sat with all of this data for hours before recording. The oil at 170. The Fed trapped it higher for longer. The margin death spiral. The CME raising margins during the crash. Congress rushing vault legislation because the system is choking. China hoarding silver before the April deadline. Each piece individually is significant. Together they paint a picture of a global financial system under more stress than at any point since 2008. But unlike 2008, when the stress was purely financial, this time the stress is financial and physical and geopolitical and energy related all at the same time. And here's what I want to leave you with. The crash in gold and silver is a symptom, not the disease. The disease is $170 oil breaking the global financial system. The margin calls are the fever, the Fed being trapped, is the immune system failing. Congress rushing vault legislation is the doctor admitting the patient is sicker than they told the family. And China hoarding silver is the smart money positioning for what comes after the crisis. Because crises end, oil shocks end, margin calls get covered, the forced selling exhausts itself, and when it does, the market looks around and realizes that gold is at 4,500 during the worst energy crisis since the 70s, that silver is at 68 while China is hoarding every ounce, that the Fed cannot cut rates, which means inflation stays hot, which means the purchasing power of the dollar keeps declining, and that the US government itself just admitted the physical delivery system is at risk of failure. I have been covering precious metals through every crash and every rally in this cycle. And I want to tell you what I have learned. The crashes always feel permanent. They always feel like this is the one that ends the bull market. January's crash felt permanent. February's crash felt permanent. And this one feels permanent too. But none of them were because the underlying forces driving this bull market have not changed. The dollar is still losing purchasing power. Central banks are still buying gold. Physical silver is still in shortage. The debt is still spiraling. The war is still raging. And $170 oil is the most inflationary force the global economy has experienced in 50 years. All of those forces are bullish for precious metals. Every single one. The only thing that is bearish right now is the margin call liquidation. And margin call liquidations are temporary by definition. They end when the cash is raised, when the accounts are settled, when the leverage is flushed, then the market reprices on fundamentals. And the fundamentals at gold 4,500 and silver 68 are screaming by. Not because I say so, because 170 oil says so, because a trapped Fed says so, because Chinese hoarding says so, because Congress rushing vault legislation says so. The data is unanimous. Only the price disagrees. And price is the last thing to align with data. It always has been. Every one of those facts is bullish for precious metals on the other side of this crisis. And the crash is giving you prices that the fundamentals do not support. Not because the market is efficient, because the market is broken. Margin calls do not price assets efficiently. They liquidate them at whatever price the algorithm spits out. And $68 silver during a physical hoarding event in the world's largest refining country is not an efficient price. It is a liquidation price, and liquidation prices are where fortunes are born. I'm not going to tell you the bottom is in. I have said that before, and I will say it again, because honesty matters more than opium. The oil is still at 170. The war is still escalating. The margin calls might not be done. Next week could be worse. But I'm going to tell you that the fundamental case for gold and silver has never been stronger than it is right now at these prices. And the crash has not weakened that case. It has strengthened it. Because every ounce that gets liquidated from a margin call is an ounce that gets picked up by someone who understands what 170 oil and a trapped Fed and Chinese hoarding mean for the future of precious metals. I want to say something to the people who are hurting right now, and I know a lot of you are. I read your comments. I see the pain. I see people saying they bought at 90 and they are watching 68 and they do not know what to do. I'm not going to give you financial advice because that is not what this channel does. But I'm going to tell you what I see. I see a market where the paper price is being set by margin algorithms during the most violent liquidity crisis in decades. I see a physical market where China is hoarding, Congress is rushing vault legislation, lease rates are at 12%, and JP Morgan pulled 1.6 million ounces from their vault 3 days ago. I see a disconnect between paper and physical that is the widest in the history of the silver market. And I see an April 1st deadline in 12 days that is going to make the physical shortage significantly worse. The paper price is 68. The physical reality is shortage. And the question is not whether the disconnect closes. It always closes. The question is when and whether you still have your position when it does. The screen says $68 silver. China says, give me every ounce you have before April 1st. One of them is wrong, and it is not China. Drop a comment. Tell me what you think. Is the margin call spiral over, or does it continue next week? Tell me what you think about the Silver Act. Tell me if China hoarding before April 1st changes your view. I will pin the best analysis. Share this video. People are panicking. They're selling at the worst possible prices because they do not understand why gold is crashing during a war. This video explains the chain reaction. Help them see it before they make a decision they will regret for the rest of this cycle. Stay informed. And every move China makes in the physical silver market. Links in the description. This is the hidden economy. Gold below 4,500, silver below 68. Dubai crude at $170. A historic record. The most violent oil shock in modern history. 3 weeks from 65 to 170. The Fed trapped it higher for longer, cutting projected rate cuts from 3 to 1. 10-year yield above 4.27. Dollar above 100. CME raising gold margins to 8% and silver to 15% during the crash. Margin call death spiral cascading through every institution on Earth. Congress introducing the Silver Act to de-risk vault infrastructure because the physical delivery system is choking. All COMEX vaults concentrated in 150 metal arms of New York and China, pulling refined silver from global markets and hoarding aggressively before the April 1st export tax deadline. Paper says 68. Physical says shortage. Congress says systemic risk. China says, give me every ounce. The crash is the symptom. 170 oil is the disease. And when the disease passes, the assets that survived will be worth more than anyone currently imagines.